Hi there, it's Dan Kerr's DK Analytics. It is December 22nd, a few short days before Christmas. We'd like to chime back in with you in terms of a follow-up video of sorts to yesterday's swamp, quote-unquote, tax cuts. And we'd like to follow up, we just brushed this topic lightly, the repatriation of profit story, which is making big headlines everywhere. And we also have an aside that we call coverage not required. As of January 19, a year from now in essence, people will no longer need to purchase health care insurance, not have coverage. But let's get into the repatriation story of this tax cut slash Jobs Act, as it's called. And for flavor, let's look at recent history. Recent in this case being 2004, when big cap companies, Standard & Poor's 500 companies, set out to lobby Congress for a pass, or that is for a big reduction on repatriation of foreign earnings, right? And Congress at that time called it the American Jobs Creation Act. And I want you to just mentally set that aside. And it promised one-time big tax break for companies repatriating overseas profits. They only had a 5.5% tax hit, right? Bringing that home, repatriating home to the United States. And companies ended up bringing back $312 billion in overseas profits, most of which was cash, and I'll get to that in a second, at a tax of only 5.25% back in 2004. Well, what this ushered in was not a lot of additional plant and equipment outlays domestically, nor a big hiring spree. If you consider what's happened with the trade deficit or manufacturing employment since 2004, they're like this. That is, the trade deficit up and manufacturing jobs down. It certainly didn't result in a lot of plant equipment or capex or employment by manufacturers. If anything, the opposite happened. What did the CFOs or the C-suite people do with it? They repurchased shares. Now, here's another interesting aspect. Despite share repurchases with that money, PEs after this passed and stocks were repurchased with repatriated foreign earnings, the PEs came down and down for about 4 years, albeit from very high levels. Does that ring any bells with anybody, possibly? Let's take a look at the current Tax Reduction and Jobs Act from, again, the potential the repatriation impact as viewed from as Standard & Poor's 500 shareholders, assuming you just held the whole index, right? According to Goldman Sachs, they've estimated very recently, I believe earlier this month, that there's some $920 billion in cash or cash equivalents. These are CDs or commercial paper or treasury bills sloshing around overseas, right? There's about 2.5 trillion of capital, that is profits, of which 900 billion is cash equivalents and 1.6 trillion is invested in plant equipment. That is a foreign value-added complex that has been erected over decades, right? But let's take a look at how this Tax Reduction Act would treat those earnings repatriated. The cash type, the type that's sloshing around in the current account that hasn't been put into fixed assets with longer-term intentions, strategic investment, those would be taxed at 15.5%. And profits that have been reinvested in long-lived assets at only 8%. The idea is if you can, in essence, get manufacturing back into this country, you're going to tax any foreign capital that's repatriated that would have to, in essence, end up selling plant equipment and putting it back into place over here. You tax that at 8%. And I don't think that's going to be happening with a lot of companies. And I'd like to go into those reasons. My point is that overseas cash flow that's been invested in overseas manufacturing and plant equipment and distribution networks and the whole long-lived asset base, as multinationals tend to do, that isn't going to be liquidated, sold, and then brought home to be repatriated at 8%. That just doesn't make any sense for a host of reasons, and let me go through those with you quickly. There's three primary ones that stick out. In other words, we're going to be limited to about $920 billion of money, a portion of which will come back to the United States, not the $2.5 trillion of overseas profits, most of which are invested. Just like if you give a bank a loan, only a small part of it is going to be kept in cash and the rest is going to be put to work in the form of loans. Same principle at work here. I don't think companies with substantial overseas operations, that is the Standard & Poor's 500 companies, which get about 50% or possibly more of their earnings from overseas, they are not going to be liquidating plant equipment and repatriating the proceeds over here. The reasons are, I think, as follows. Number one, there's an over $2 trillion annual regulatory compliance cost, most of it borne by manufacturers in the United States, right? And there is an explosive amount of new federal regulations hitting the books literally every day. This stands in stout contrast to President Trump's frequent talk about we're cutting regulations, and I will show you a page that you can refer to yourself for confirmation of the same. So, not from a regulatory perspective. Also not from a liability or legal perspective. The United States, given the litigation environment, cost as a percent of GDP for companies to deal with the legal/litigation costs is nearly 3 times as high as a percent of GDP. It's about 1.7% versus something like 0.6% in Europe. So it isn't the legal environment that's getting any better. It's not the regulatory environment, despite headlines or Trump statements, that's getting any better. It might, but it's not yet. I'll get back to that slide. And last but not least, there is substantial uncertainty, political uncertainty. Now, under Trump, he's doing good things on at least some very good things beyond the, trying to get back the fidelity to the Constitution. He's trying to open up America for business again, at least at the margin. But realize that we have an election in 2018, and the Democrats could take back control of the House. It typically happens in an off-year election to the party that's in a minority position. And at the same time, Trump's approval ratings are about 35% for devious reasons, but it is what it is. So political uncertainty is also large. And if that wasn't enough, most of the provisions in this Tax Reduction Act, Employment or Jobs Act, expire by 2025. So you're not going to have on board the kind of long-term carrots that will encourage companies to regain their U.S.-based manufacturing footprint. Thus, we're really looking at the $920 billion in cash and equivalents sloshing around, right? Let's get back to that for a second. Let's say that American multinationals, actually Goldman Sachs estimates $250 billion earlier this month of that 920 will come back here to be taxed at 15.5%, right? Let's say it's half of that. Let's be generous. Not just 250 billion, let's say 460 billion. Let's further say that that's taxed at 15.5%. That gives us just a little bit shy of 390 billion with which to redeploy said funds in the United States, right? And I think those are going to be mostly stock buybacks, right? Much more than dividend increases. And as I said, I don't think that for the reasons mentioned, regulatory liability costs and political uncertainty, we're not going to see those companies necessarily abandon foreign operations and bring the other stuff home. By the same token, I think they're unlikely to reinvest a substantial part of the, I'm guessing, 460 or 390 net that they're going to bring back. The emphasis will be on increasing short-term earnings per share, right? And until there's greater clarity as to the sustainability of a more friendly business environment in the United States, I don't think that's going to happen. But you know what? Let me make the point dramatically with the regulatory bit, because I think this needs to be underscored. I don't think people are going to believe me. But here we go. Here's the one page. Let me get this up here. Why the regulatory situation isn't improving, despite what you hear. And here we go. It's regulations.gov is the website, all right? You can go online right here. It's www.regulations.gov. And if you go to the middle column here at the bottom, you see, and this is dated December 22nd today, you see 60 new proposed regulations today, just today. And for the last 9 months, you see 5,962 new proposed federal regulations. This is from the government itself. That in no way, shape, or form suggests an improving, in a global sense, regulatory environment. And frankly, the new regulations posted in the last 90 days is about 900 higher than it was before Trump got elected. So I hope I can make that point well, that they're not necessarily going to see regulatory relief, and I'll let the political uncertainty and litigation costs stand at where they are. But if we go back to some basic math, and we take a look at, say, 460 that they bring back home, the cash and equivalents, not giving up plant and equipment, but just the cash and equivalents, and bringing them back, getting hit at 15.5%, having 390 billion, 389 billion to work with in order to then effectively retire shares. They're not going to do they're not going to do dividend increases for two reasons, or at least not in a big way. Number one, this is a one-off, a one-time item. This isn't a recurring cash flow stream. This is a one-time tax advantage, right? So they don't want to commit to heightened dividends, especially not if they can't maintain them in the out years, right? And then have to cut them. That's about the worst thing you could do for your stock price. And that brings me back to the C-suite, or the top brass in a company. They're very concerned about the stock price. And related to that stock price, the best way to get it up historically, or at least in the recent past, is to shrink the share base. So let's get back to shrinking the share base. The current market cap of the Standard & Poor's 500 is nearly 24 trillion. The index at 2682 earlier today. We got nearly $24 trillion. That's the market cap of all the Standard & Poor's 500 companies. And the exact number is 23.785 trillion. Now, by the way, the Standard & Poor's 500 captures about 80% of the public company market value in the United States. So it's really indicative of corporate America, all right? If we take the market cap of Standard & Poor's 500, nearly 24 trillion, and we have net earnings. These are GAAP numbers, real numbers, not operating numbers that neglect ongoing restructuring costs, but GAAP net earnings of Standard & Poor's 500 are nearly 1 trillion. More precisely, they're $952 billion current run rate. If we divided almost 24 trillion market cap by 952 billion, we come up with a PE of, you guessed it, 25 times. If we now take those 390 billion and we retire shares, all right, what are we doing? We're paying 25 times earnings, so our return on investment when we're buying back stock trading at 25 times is only 4%. After tax, given about a 21% tax rate, a little bit over 3% return, 3.2% after tax return on investment. Not a tremendously big deal, right? But that's about the lift in Standard & Poor's 500 stocks, 3 to 4% lift in stock values that would result from putting those funds at work, very substantial funds, but very small relative to the bloated value of the Standard & Poor's 500, namely nearly 24 trillion. Now, if companies were to do this at a PE of 10, right, then the pre-tax return on investment would be 10%. Now, that would look much more attractive. After tax, 8.5 or something like that. But sadly, and this is true, trust me, I've been following this for 35, 36 years, companies tend to buy back stocks when their PEs are 20 or higher, and comically, sadly, sell stocks because they've levered up their balance sheet to buy back stocks at higher PEs. They have to go out and support their balance sheet or liquidity, and typically then sell stock at a PE of 10 and dilute the living crap out of existing shareholders. But what is the overall story here? The conclusion is this repatriation business, there's less to it than meets the eye given current stock valuations, PE of 25, given the regulatory, the litigation, and the political environment, and the fact that these things expire, most of them by 2025. You're not going to get American corporate chieftains to do a 180 with their aircraft carrier overseas, all right? Separately, I also mentioned that I wanted to talk about coverage. It's no longer required. What am I talking about? Another feature of the Tax Reduction Act and the Jobs Act is to repeal, get this, to repeal the individual mandate penalty by lowering the penalty amount to zero for people that don't buy health care insurance. Now think about this. People can now wait until they're sick to purchase health care insurance. That is, those people that insure themselves. And given the fact that we have more and more part-time jobs, right, since Obamacare misery hit, a lot of people are looking for individual insurance, but they no longer now have to buy it. They can buy it once they have an incident, an accident, an illness, and they require care. Well, think of it like this. If I was able to go out there and buy fire insurance after my house burned down, or I was able to buy car insurance after I got into an accident and totaled my car, why then, what insurance company could ever survive like that? An insurance company, for it to work, needs a vibrant, healthy, diverse pool of insured that collectively only have a couple incidences. Say you have 100 people in a good insurance pool with good diversified risks, not just sick people or people whose houses have burned down or people have been in car accidents or will be, but, maybe 2 or 3 outsized claims out of 100 people that paid in their premiums. That's how insurance works. They use the float to pay that, and then they invest what's left over to earn a rate of return, to generate a profit. But you cannot, as an insurance company, operate on a basis of simply paying people out when they have had an accident or they require funds. You just can't do that, all right? And by extension, if you consider where is this funding going to come from? This funding is going to come from the U.S. government, the U.S. taxpayer. So individuals can punt on having to pay for their own coverage. Insurance companies will have to find a way to pay out huge amounts without having the benefit of a lot of insurance coverage payments or premiums paid. And the only way that this is going to work is by the government running even larger payouts in this direction. That suggests huge potential deficits in the wings from this, especially when we consider the fact that American healthcare spending last year was $3.3 trillion, And as I said earlier, a substantial part of those people now have individual mandates. They lost their corporate plans. They got laid off. We have, thanks to Obamacare's companies terminating full-time positions. They don't have to insure for health care if they're part-time or less than 29 hours. So this is a very significant, probably a detail that's not going to be focused on much, which could over time add very significantly to the deficit, to government spending, because they, insurance, are going to have to backstop people once they get sick without the benefit of premiums being paid in by a healthy pool beforehand. And if we consider the $20 billion that Mitch and the boys, the cronies, are kicking in order to make this work, which will result in about $300 billion more spending this coming fiscal year, then that $20 billion is going to look like a pea compared to the net liabilities that the federal government will have once we no longer have any penalties for individuals that don't have to purchase health insurance. That is prior to getting sick, right? What does that mean for valuations? I always try to bring it back into valuations. It means the following. It means that deficits are likely to get even larger as a result of this, and possibly substantially larger, given $3.3 trillion of spending annually and a large part of people having individual insurance no longer being insured at the workplace, as mentioned. And that could come together or conspire to make deficits even materially bigger than we stated in the last video. And that in and of itself could add insult to injury in terms of bondholders' perceptions of either solvency risk or monetary inflation risk. And as I said, it isn't solvency a priori in the U.S. because the government can print, but it definitely, inflation is nothing other than a piecemeal insolvency because your purchasing power gets shredded over time. So those are the concluding remarks. I want to wish all of you a Merry, Merry Christmas, great family get-together, and again, a healthy and prosperous 2018. We hope you find this of interest. Thank you very much. Bye-bye.